Investors will get some more insights on the consumer this week with a busy docket of retail earnings and the latest retail sales report, housing starts, and minutes from the most recent Fed meeting. Got a lot on tap. Joining us now to talk more about it, Ashish Shah is Chief Investment Officer of Public Investing at Goldman Sachs Asset Management. What is public investing?
Public markets.
Oh, okay. I wasn't sure if it was, the government or something. Got it. Okay, so you do it all. You cover it all.
Stocks and bonds.
What do you think then about the relative value in stocks versus bonds right now?
Look, I think both are offering kind of interesting opportunities, but given the market has priced out kind of this very benign soft landing scenario, the risk return is not looking as good as it did 3-4 months ago.
So you're in kind of the Barry Bannister camp and all that. We were talking to him earlier this morning. He's just kind of saying the same thing. The upside seems a little bit more capped from here. Yeah,
well, and you're going to continue to go and deliver decent returns because the economy's, it's not falling off a cliff here. I think the thing you have to worry about is concentration that's developing in your portfolio.
Sure. If you own the names that are the Magnificent Seven and all of that, time to rotate. So what about bonds? Are these the ones that, if everyone's talking, who was it just a moment ago? Oh, right. We were talking about gas and oil prices. And our guest from Rapidan, Bob McNally, said, look, the Saudis are continuing to keep supply in check because they're worried that this could be 2008. We wake up tomorrow and oil's at 40. If there's even the possibility of that, why shouldn't someone in their portfolio have a bond, a 30-year, a 10-year, a 5, a 2, whatever it is, yielding what it is against the possibility that we could see a material slowdown in the economy?
So, Kelly, I love the fact that you love bonds, and I can't agree with you more that these types of yields are really interesting. I think the question is, which part of the curve do you want to be in? Because 30-year, you can make a strong argument. Joe, you were making it before of we could be at 8%. A lot of things would have to happen between here and there.
I don't say we're going there, but at least at 8%, I'll double my money in 9 years? 4%, rule of 72.
Yeah.
But I'm not trying to double she sleeps with her light. She sleeps with her light on.
4% guaranteed.
You heard of a stock called Nvidia or Apple or
Nvidia is down like $80 from its recent.
I know, but at Netflix, find a business you like. Find a business you like.
A lot of us have
reasonably priced stock and invest for the long term.
Our entire 401ks are in the stock market.
Okay, for money that you need to have. Go ahead.
Yeah,
you can do that.
It's also for money that you want to be able to invest when there is a dip, right? Your bonds are there.
Well, that's not a 30-year. I wouldn't do that on a 30-year.
But a 1 year.
Okay.
The 30-year worked pretty well during the pandemic, right? It was the one thing that worked for you in your portfolio.
Paint grow. You should have done. I could have bought 13.5% triple tax-free AAA bonds.
Wow.
That's what you
regrets?
Could. No one bought it. All my clients wanted to buy floating rate because they thought it was going even higher.
Well, here's the thing. They all matured. Now what are you doing?
They all got called before they matured. Exactly. I don't know. Maybe. How about a convert? How about some converts? Do some converts.
Let me flip it around. What are we, if you and I, or you especially, because you're the true expert, if you think that bonds are so exciting here, what are we missing? That it can't be. Is it that obvious? It can't be that obvious. Are they? Maybe the 10 years going to 6%. I don't know.
It isn't that obvious because the answer is that we have seen a lot of volatility when it comes to inflation, but that also creates the opportunity to buy bonds at a real rate that we haven't seen in well over a decade. Right, earning around 2% real rate. Out the curve, locking it in, as we were talking about, that hasn't been around. And given the underlying growth rates of the U.S. economy, it's not clear to me that you need to earn more than that.
If we're going to 130% debt to equity debt to GDP, and we're going to have trouble paying our debts. Rates are going much higher. Why would you buy something at 4%? For my entire career in that business, rates were 8%.
But if we have trouble,
you think they're going down from here?
But wouldn't we take that money if we literally can't pay the debt? Then we have to stop paying something else. If we stop paying something else, the economy weakens. You know what I mean? Like, it gotta.
These are all horrible.
Look, inflation is not good. Those types
People
of
who buy
real
bonds
rates
are depressing about the future. They're very depressed about the future. You're negative, and I just don't want to be around you people.
Is there anything else, Ashish, then to leave it on a more optimistic note? I mean, certainly you said you do like equities here in some ways.
Look, I think that there's a tremendous amount of secular growth that's going on in the equity market right now. And the types of changes that we're seeing across AI, across innovative business models.
But you can't own anything because it's all too expensive, or can you?
You can go outside the U.S. and find really interesting opportunities. You look at places like Japan; they're going through secular change, where companies are trying to diversify their supply chains, and the only places you can go are places like Japan or India to find interesting companies.
All right, there you go. See, don't you feel better already? Go to Japan and India.
It is the dismal science. It is. It's dismal. People are depressing.